welcome back to my channel. Welcome back to another episode with Boss Beauty. My name is Ola Tejibelo if you're new, and if you've been coming along, thank you so much for coming. Thank you so much for staying. I appreciate all of you guys. On today's episode, we're going to be talking about insurance. Insurance is an important, like a very important aspect of your mortgage, of your life, of everything that you are as a human being. A lot of people actually only find out about insurance when they are about to take their mortgage. It shouldn't be like that. You should literally know about insurance. There's lots of advices out there for insurance. There's lots of information. There's lots of ads. You just have to not be ignorant about it. I'm sure all of you has heard about insurance, especially life insurance, but most of the time we tend to be ignorant and just say, oh, I don't need it. Oh, it's for older people. Oh, it's for white people. There's nothing like that. Insurance is for every human being. Just as you have your car insurance, that is how other insurance are important as well. Now, let's break it down. There are different types of insurance. You have your life insurance, which is an insurance that pays out after death. So it covers your dependents when you are not there anymore. So in simple English, the life that you live with your dependents, your family, you go on holiday every month, you go McDonald's, you go Nando's, that life that you live with them when you're around. If you're not there anymore, how are they going to carry on with that kind of life? So that is why life insurance is very important. Your children are going to private school, you have private car, you have your loan, your car finance, you have your mortgage. Literally, life insurance will cover everything that you own as long as you do it the right way. Now, saying that, you don't want to do a life insurance of £50,000 and you expect it to cover your mortgage, you expect it to cover your car loan, you expect it to cover your children's school. That is not possible. So life insurance pays out after death, and this is something that covers for your dependents when you are not there anymore. Now, the next one, we have the mortgage cover. Mortgage cover is a type of life insurance. Now, the difference is with life insurance, it is called a level term. Level term, that is, if you start with £20 for £200,000 for 20 years, everything remains the same. So now let's think about it. You've done a level term life insurance of £200,000. You've got a mortgage of that's left maybe £150,000. Now, maybe 10 years down the line, death has happened, you've paid your mortgage and your mortgage is remaining £50,000 or let's say £100,000. Your life insurance is £200,000. So what will happen is your level term life insurance gets paid to your family, and the remaining of your mortgage can be paid off by your family from that £200,000. It can pay off your loan, your car loan of maybe £25,000. You still have £75,000 left. If your children goes to private school and maybe they are in their second year or whatever, they have £50,000 to pay. It can pay from the remaining 75 and you still have £25,000 left. That is how the level term works. So the level term gets paid to your family and they use it to sort out, whatever debt or whatever you want to use it to cover. And this can be based on whatever you have in your will. So if you don't have a will and you have loads of properties or loads of investment, lots of assets, let's put it that way, how will the family know how to actually spend or, break down or use your life insurance? So yes, you have a life insurance. A will is also important. We'll not talk about that today, but that's what that is. Now we're talking about the mortgage cover, which is called a decreasing life insurance. So the first one I said is a level term, everything remains the same. A decreasing life insurance is usually a mortgage cover, and what that does is it covers your mortgage and any loan that you have. And the reason why it's called decreasing is because as you're paying off your mortgage, you're paying off your loan, the amount that you've borrowed has reduced or is reducing. So this decreasing cover reduces based on the interest rate that you have, either on your loan or on your mortgage. And the reason why that is called decreasing again is, example is you started with £20,000. No, you started with £20 monthly, cover you for £200,000 because that was the amount of your mortgage when you took the insurance. And this is to cover you for 20 years. Because you're paying off your mortgage on a monthly, yearly basis, this mortgage reduces. That is how your £200,000 is reducing as well. And that is why it is called a decreasing cover. The disadvantage to that is once your mortgage is paid off, that decreasing cover that you have of £200,000 is finished. You do not owe the bank or your lender or your provider, you do not owe them any money. So you don't have to pay them premium anymore, and they do not owe you anything because your mortgage has been paid off. So they don't owe you anything. However, death happens within that 20 years that you're covered and your mortgage is remaining £100,000. That mortgage will be paid off by your decreasing cover. Because you were covered £200,000 does not mean that they will pay out £200,000. It would only pay out what you have left on your mortgage. And that is why it's called a decreasing term. The disadvantage to that is sometimes it finishes even before death happens. And this is because you're paying extra into your mortgage because you want to be debt free, you want to be mortgage free. This decreasing cover is finished once you've paid off your mortgage. Now, you need to make sure you check properly. A lot of people tend to go for the decreasing cover just because it is cheaper than the level term. But both of them, level term life insurance, decreasing life insurance, both of them are part of, or they are the same type of life insurance. So they are called life insurance. So it gets a bit confusing when you're offered the decreasing, not knowing that this is going to be reducing as you're paying off your loan. So if you don't have a mortgage, you don't have a loan, please, why are you taking a decreasing cover? Think about it. Right. Now, when I said a lot of people actually find out about this insurance when they are about to take a mortgage, is because once the mortgage advisor is advising you about the mortgage, they would also advise you to take the insurance. It's an advice. It's not compulsory. But people tend to believe, these mortgage advisors because obviously they know what they're doing and they're giving you the right products and they're giving you the right advice. But it's not everyone, again, that qualifies for an insurance. So, for example, myself as a sickle cell anemia sufferer, let me put it that way, or someone that has sickle cell disease, I have not been able to take a life insurance. I have taken one before that I paid for 2 years, £50 every month, yes. And it was supposed to cover me for £200,000. And I think it was for 20 years. Eventually, when I opened this document that was sent to me 2 years later, I realized that it had excluded any complications relating to sickle cell anemia. Please, why am I doing life insurance if it's not going to cover my sickle cell? Yeah. So when you are going to the mortgage advisor or you're doing it online, it will do it, or it will tell you that yes, you can get it. You will be paying that £75 every month. But if you don't check it properly and you're not careful, you're doing the wrong thing. And then some of you guys, you already have this life insurance. You already have the protection in place because you've spoken to an insurance advisor like myself. I have given you the right advice, but because you're now going to a mortgage advisor, you think, oh, they know better than my insurance advisor. No, they don't. A mortgage advisor is, particularly there to help you with getting the right mortgage. Yes, they can help you to get the right insurance, but if you already have something in place, don't just cancel it because it's coming from your mortgage advisor. No, you need to make sure you compare and contrast and check with your insurance advisor to make sure that what your new mortgage advisor is bringing to you in terms of insurance is something that would actually be useful. A lot of the times, they are not giving you what you already have. They are probably giving you less than what you have, or they are giving you a duplicate of what you already have. Eventually, you're paying for two types of insurance done by different sets of people, but then you're paying for the same thing and you're paying more money. See? That's why I said, please, let's not be ignorant when we're talking about insurance. You need to be careful. You need to know what you have. Please, if you already have an insurance in place, just because you know a new insurance advisor, or because there's an offer online, or because you're not taking out a mortgage and your mortgage advisor is bringing you something, it does not mean you should cancel what you have and jump to it. Always check and compare what you have before you go for it. A lot of the times when a mortgage advisor is advising you or giving you an insurance, check it properly. Most of the time it's a decreasing cover. And the reason why that is because they are protecting the mortgage that you are taking out. Yeah, they are protecting the mortgage that you're taking out. They are not necessarily protecting your life. Your life is a level term life insurance. If it's a decreasing term mortgage cover, yes, it's a life insurance, but it only covers your mortgage. So please, let's be wise and let's be careful. Another type of insurance that you have, it's a critical illness. Critical illness pays out a lump sum amount when you are diagnosed of something critical, of a critical illness, injury. You cannot look after yourself ever again. An example of this is stroke, cancer, Parkinson's disease, anything that you can think of that is critical. It also covers terminal illness. So these are things that you cannot look after yourself ever again. Now, critical illness is not something that pays for your mortgage. No, it pays out when you're diagnosed of something critical. A lot of the times, critical illness is the most expensive cover. So now, if your mortgage advisor is giving you a critical illness of £200,000 and you're paying maybe £75 premium, please check it properly to make sure it's not a decreasing cover. Yes, there is a decreasing cover for critical illness, and again, this is because the advice is coming from you protecting the mortgage that you are taking out. So if it's decreasing as well, again, that critical illness is decreasing as you're paying off your mortgage. So as much as possible, you want to make sure that whenever you're taking insurance, you want to take out a level term insurance. Yes, you can take a decreasing cover. Let's say in a situation where you already have a level term life insurance of £200,000 before you start to think about mortgage. Now you want to take out your mortgage. It's cheaper for you to do a decreasing cover of £200,000 to cover that mortgage, because you want to just protect that mortgage. You already have something that protects you, your dependent, and your life when you're not there anymore. So everything else that you own will be covered under that level term, and your mortgage will be paid off by the decreasing cover. And usually, like I said, the decreasing cover is usually cheaper. So yes, you can take that as extra, but please don't take a decreasing cover over a level term cover. Another type of insurance that we have is income protection. Income protection is something that pays out a monthly payment when you have or when you are unable to work for a long period of time. So because of sickness, because of injury, or because of accident, your doctor has said you cannot go to work for 1 year, 2 years, or you cannot even work for life. Income protection pays out a monthly salary. So you can call it a monthly salary or a monthly payment. It looks like a salary because it is paid monthly. So that is income protection. Now, income protection, again, can be level term or can also be decreasing cover. When you have it as a decreasing cover, it might say something like a mortgage monthly payment cover when you are, unable to work for a long period of time. Please check it properly. Again, always go for a level term more or priority over a decreasing cover. Take a decreasing cover as extra if you feel like yes, you can afford it and you already have a level term cover, not a decreasing cover over a level term. Yeah, both of them, they work hand in hand. They are important. It is what they cover or what they are defined as that matters. A level term remains the same. A decreasing cover reduces over time. There is also an increasing cover for this life insurance and for this mortgage cover, and what that does is, with the inflation rates that we have now, if you have taken an increasing cover, your cover, so your premium would have increased, what you're paying monthly, and what you're covered for would have increased as well. That is, your benefit would have increased as well. So income protection pays out a monthly amount when you are unable to work due to illness or sickness or injury, accident for a long period of time. The next one we have is the accident and hospitalization. Accident covers any form of accident, and hospitalization when you are, hospitalized for one thing or the other. For days that you spend in hospital, you make a claim for that, and that is insurance that covers you when you are alive. Life insurance covers after death, so when you're not there anymore, the people you're leaving behind are benefiting from it. Income protection, it covers you whilst you are alive, but you are unable to work because you're sick, you have an injury, you have an accident. Income protection will pay when you are alive. Critical illness, when you are diagnosed of something critical. So critical illness, when you are unable to work due to long-term sickness. Again, that can pay out when you are alive. You've already been diagnosed and you only have maybe 12 months to live, then yes, you can benefit from your critical illness by yourself. Sometimes some critical illness will just happen and take you away just like that. Critical illness will still pay out. Again, the next one, the mortgage cover, it covers when you are not there anymore. It pays off your mortgage or whatever loan that you have taken that decrease in cover for. If you have taken a monthly mortgage payment, then that would pay out when you are unable to work due to illness, accident, or injury, and you are unable to meet up with your mortgage payment, then that decreasing monthly payment mortgage cover will pay your mortgage. So again, make sure you check all these policies and you check what you're covered properly and understand them properly. But like I said, there are different types, and which ones you can take depends on your health, your age, your family size, sometimes your BMI. The type of insurance that you can take varies depending of different circumstances. As I mentioned, your age, your BMI, your medical history, your life as a whole, and different things. So sometimes when your mortgage advisor brings you this insurance, make sure you understand what you're signing into as well, and make sure it is the right cover for you. With insurance, I am giving you a lot of this information based on what I actually do as a business. So please, let's be wise and let's know what we are getting into. Any form of insurance question, please put it in the comment section or send it to me privately, and I'll be sure to answer you. Anything to do with mortgage, I'll be able to answer you based on my personal experience, not based on what is out there. Yeah, so please, let's stay advised and let's understand what we are getting into. Another type of insurance that your mortgage advisor will advise you on is the building and content insurance. Building and content insurance is actually very important, and that's the only one that I feel like, yes, if your mortgage advisor is bringing to you, take it, but also you can check online. And the reason why I said you can check online is sometimes what your mortgage advisor is giving to you in terms of insurance is not necessarily what you need or what will be useful to you or the cheapest out there. If you already have an insurance advisor, please always go back to your insurance advisor, because they are advising you based on your personal circumstances and based on the different information that you've given them personally, rather than what is available in the market. A lot of the times when your mortgage advisor is bringing you any product, it is what is available in the market. But your insurance advisor is bringing it to you based on your personal circumstances. So, like I said, it's not every type of insurance that everybody can get. A building and content insurance, I think I've mentioned this one before, is very important because a building cover will cover everything that has to do with your building. However, accidental damage is very important, and a lot of people tend to take this one out. The reason why we take it out is because it's an additional benefit and you pay extra for it. But what accidental damage means is, for example, you are doing, something, you feel like, oh yes, I'm a handy person and I can fix my own washing machine, and then, one of your pipe is burst and then you're trying to cut it or whatever, or you're just fixing it and then accidentally you cut an important part of your pipe that leads to or that provides water into the washing machine, or even provide water into the whole building, then that is an accidental damage that if you don't take accidental damage on building, then that would not be covered. Another accidental damage example is, let's say you're driving into your own driveway and then you mistakenly, or somebody, driving on the street just accidentally drove into your own parkway and then hit your car, or you've done it by yourself, you've driven into the wall, you've caused the damage, then that part of the building will be covered. Your car is not covered because that is part of car insurance, but it is an accident that has happened to your building, so accidental damage would let you be able to make a claim on that kind of cover, on that kind of policy. So please, let's be wise. And then we have the content insurance. Content insurance is basically when you turn your building upside down, everything that will drop from that building. So things like your cooker, things like your clothes, things like maybe your sofa. Yes, you would say your washing machine, you would say your fridge freezer or your deep freezer. These are white goods. So we need to be careful, when you're doing content insurance, you need to make sure you add accidental damage as well. And the reason why you're adding accidental damage, an example of that again is your TV. If your TV just decides to stop working, internal problem, then your basic content insurance would cover that. But your son, your daughter, whoever, somebody in your family has now decided to clean your TV, and then there are lines on the TV. Obviously, you've caused that damage. So that is accidental damage. Your child has played football and they've kicked it into the TV is shattered, is broken. That is an accidental damage. Your sofa, you're drinking wine and then you poured, your wine on the sofa. Your sofa is color white or one of those colors that a red wine will easily stain it and it will not come off. That is accidental damage. So if you don't have accidental damage, you cannot benefit from those kind of claims. You will not be able to make claims on such kind of policy. So you need to be careful when you're doing all of this type of insurance. And another thing is that comes with the building and content insurance is your excess, your compulsory excess. Again, let's be wise when we are choosing our compulsory excess and voluntary excess. I have fallen a victim of voluntary excess before when I did my car insurance, but I am not going to do that again. I think I've shared that a few times on this channel. Please watch my other videos and you'll be able to learn from different things that I have shared. But your voluntary excess is basically when you want to make a claim, or your compulsory and voluntary excess is when you want to make a claim. These are excesses that you have to pay before you can claim. So let's say, for example, you've done a compulsory excess of £350 because you want your monthly premium to be cheaper. Now you want to make a claim on your TV, but your TV is only worth maybe £200 or £100. You got it from the market. Before you make a claim on that TV, you would have to pay that £350. So when you're choosing your excess, let it be as low as possible, because whenever you want to make a claim or when something happens, you might not even be buoyant enough at that time to say, I'm just going to buy another one anyway. But again, you might not be buoyant enough to pay that $350 excess that you've chosen. So always make your excess as low as possible, at least £100 or £50 if possible. Don't say because you want your premium to be £10 monthly, you're going to now increase your excess to £500 or £1,000. Yes, those are the kind of excesses that I've seen people picking just because they want their monthly premium to be cheaper. When I now explain to them that, okay, so if you want to make a claim on your TV and they ask you to pay £1,000 for your TV, are you saying, yes, you will pay that? Oh, I only bought the TV from the market. For example, the first TV I had was from the market. If not even for the first TV, I think I only just got a proper TV from Corey's 2 years ago. Before that, I've always bought it from the market or Facebook Marketplace, Argos, and they're always cheaper, like under £500. So if I'm now making a claim and I have to pay £1,000 to claim for a TV that I bought for £500, I'll just go and buy another one. So people will say to you, oh, insurance doesn't pay out. Is because they've not done it the right way. So please, let's be advised and let's make sure we're doing the right policy. And when you're doing it for your building as well, with your building, you might think, oh yeah, they don't really happen often, but anything can happen to anybody at any time. So again, when you're choosing your building one, yes, that can be, about £250, but don't make it £500 still, because you never know what's going to happen. You never know. So let's be careful and let's be wise. So, thank you very much. I will see you next time in my next video. Bye.